Hello, good afternoon. You're watching Closing Trades on ET Now. I'm Anisha Jain. With me is Aisha Faridi. Well, the last 1 hour of the trading session has been rather eventful with the earnings coming in from the likes of Asian Paints, SBI, HPCL, etc. For Asian Paints, of course, it was a clear-cut miss, but SBI surprised the street positively, and for HPCL as well, it was a miss. But at the index level itself, the Nifty continues to hover just around the 22,000 mark, threatening to go below at one point of time, but there is that strong defense coming in from the bulls at that level, so clearly watching out for that. India VIX continues to spike, so it's up another 4% today, nearing the 18 level ahead of the weekly options expiry for Nifty. All sectors are clearly in the red, barring auto, within which the likes of TVS, Hero are reacting to earnings, and it's lending a support to the likes of Bajaj Auto, M&M, etc. But barring that, rest of the market is firmly in the red, and as I talked about, SBI surprised the street positively, so it's getting rewarded, while L&T has not seen any buyers. That margin disappointment is something that the street is clearly not liking.
Yeah, absolutely. And I'm just looking at the global screen because it's a little puzzling as to, it almost seems like our markets are a standalone case of weakness today. Sure, there is Korea and Australia, but not as such large markets. Hong Kong, of course, on a tear, 1.25% higher. It's an over 200-point bump up. Shanghai, very strong, almost a 1% notch up coming in there. Japan, just about mildly soft. Europe has started off absolutely flattish on trade. A few dots of green for a DAX, for a FTSE, for instance. And even the pre-market US futures are not really indicating any, sizable weakness. So clearly, it seems like it's a standalone hour market weakness kind of case. But here's India's biggest car maker, Maruti, launching Epic Swift. And here's my colleague in conversation with the management.
This new, Epic new Swift, all new design and from the scratch, but still holds the iconic DNA of Swift on overall exterior design as well as interior design. But at the same time, we put the one of the best, engine into it. This is the new Z series engine. This is the biggest change of this car. This new Z series engine has a better fuel efficiency and less CO2 and even better drivability for Swifters at the same time. So this is the biggest change of this car.
And at a time, well, all car makers are launching SUVs, compact, bigger ones. You have launched a premium hatchback. What makes you so optimistic, and what is your outlook for hatchback market, the revival of the market?
Of course, we also focus on SUV at the same time, as we introduced series of SUVs last year. But this year, we have to revamp this hatchback also, because we cannot keep the same model for such a long time. So somehow we have to introduce a whole new Swift.
Okay, so that's a word coming in from Maruti, but it's earnings reaction and they're getting a lot more accentuated right now. Take a look at Piramal Enterprises. It opened with a cut of almost 3%. From there, it hasn't seen any recovery. In fact, it's now at the lowest point of the trading session, almost a 10% coming in there. Manappuram Finance has been fairly wobbly. Of course, it's better than that 9% cut that we had seen initially. But after that 6-7% downtick, it's not seeing any buyers at lower levels. L&T, it's a similar case. It wasn't such an ugly number in my reading, but clearly the street is disappointed about the margins despite the order inflow guidance being strong. On the positive side, however, Paytm has finally come out of its lower circuit, so today it's up 5%, and Vijaya Diagnostic is reacting to earnings as well. Let me welcome on board our technical experts as well, Shivangi Sarda as well as Kunal Bothra is always with us. Kunal, let's start by discussing the market mood itself. How strong do you think is the defense at 22,000 from the bulls, or it's very likely that in the last 1 hour of the trade we will go below that 22,000?
Good afternoon. So, with such kind of a VIX and these kind of market circumstances which you've seen in the last 5 days, it's very difficult to now, look at these strong psychological mark, which could probably hold on to, these supports they generally hold on to when there's a normal flow of correction for the indices. But with India VIX today touching the 19 mark, we are now at almost 17.8, 17.9 for the India VIX. It generally is an indication that we could be at a more corrective phase going forward. The bigger concern for the markets is not just VIX, but it's the slew of large cap names which are now showing signs of crack. Many of the large cap stocks which were trading above the 50 DMAs, for example, they are now coming closer to and threatening to go below the 200 moving average. L&T, for example, is one of them. ITC today has fallen down significantly from retesting its 200 moving average just 2 days back. So I think with this slew of large cap names now showing signs of weakness, which was erstwhile showing signs of strength, I think that's the bigger concern which is now originating into the indices.
Yeah, it sure is. Before I take it across to Gaurav and get a summary on how SBI's performance has been, Nitin, hi, afternoon. What's leading to this nervousness in the market, and the exodus by FIIs almost on a daily basis, and the quantum just keeps doubling? Do you think this is just pre-election nervousness, or is there something more to it? Nitin, you'll have to unmute yourself.
Yeah, sorry. Hi.
Hi.
My apologies. So if you really look at the FPI flow, it's a continuation of what we have been seeing for the last many months. In fact, this was the same pattern that was followed even last month. But clearly, as we're getting closer to the elections, and as you're getting different sort of viewpoints emanating on the ground, it does look like that there is a nervousness in the market with respect to election and with respect to formation of the government, or rather what sort of majority would the government get. Also,
hold that thought. Sorry, the SBI management is actually speaking, so let's cut across and listen into Mr. Khara.
The conditions are, however, shaping up for an upshift in the real GDP growth, backed by the strong investment demand and upbeat business and consumer sentiments. CPI inflation has already gravitated to 4.9% in March, after averaging 5.1% in the preceding 2 months. CPI inflation is expected to moderate in ensuing months and is expected to taper to 4.5% in financial year 25 compared to 5.4% average in financial year 24. In financial year 24, the credit offtake of the all scheduled commercial bank recorded a growth of about 20%, while deposit grew at about 13%. And the momentum with some moderation is expected to continue in the financial year 25 too. I'll now discuss the broad bank's performance parameters. Once again, we have delivered excellent numbers. I'm happy to share that our net profit for financial year 24 is the highest ever at rupees 61,077 crore, showing an increase of 21.59% over financial year 23. Our net profit for the quarter 4 of the financial year 24 is at 20,698 crores, which has increased by 125.87% sequentially. This is despite incurring wage revision expenses of rupees 13,387 crores during the current year period as per the bipartite wage settlement, and after absorbing the additional liability to the tune of rupees 7,100 crore relating to pension liability and the DA relief neutralization in the third quarter as a one-time exceptional item. Our ability to absorb the above liabilities without significantly impacting the long-term profitability outcomes of the bank demonstrate the resilience of our balance sheet. ROA of the bank stands at 1.04% for financial year 24, and it has improved by 8 basis points over financial year 23. The ROE for the financial year 24 is at 20.32%, which has improved by 89 basis points over financial year 23. We have been consistently delivering ROE in excess of 15% for the last 7 quarters. The cost-to-income ratio of the bank is at 55.66%, including wage revision expenses and excluding the impact of the one-time exceptional item of pension liabilities and dearness relief neutralization in quarter 3 financial year 24. Excluding the wage revision and one-time exceptional item, the cost-to-income ratio would be at 49.34%, which is an improvement of 315 basis points over financial year 23. Non-interest income has shown a growth of 41.15% in financial year 24 over financial year 23. Our deposit has grown by 11% YOY and term deposit has grown by 16% YOY. We are mindful of our liability portfolio as it provides a stable stream of resources for us. We continuously monitor the concentration of our deposit profile daily, ensuring that dependency on the wholesale funding is contained within the prescribed levels. Liquidity coverage ratio stands at 124% as on 31st of March 24 and is well above the regulatory benchmark. I'm happy to highlight that the credit growth has been robust across all the segments. Our retail, agri and MSME, which is popularly known as RAM, advances have crossed 20 trillion mark during the year. Out of the above, retail personal advances constitutes 13.5 lakh crore, which is 13.5 trillion. Agri advances are at 3.05 trillion and MSME advances stands at rupees 4.33 trillion, growing at the rate of 14.68%, 17.92% and 20% respectively. The corporate segment is also showing healthy growth at 16% plus YOY growth. I'm glad to share the progress we are making in digital banking. 61% of our savings bank accounts are opened through YONO in financial year 24, and we are also leveraging analytics with significant business accretion. Now it stands at 1.37 trillion as against 1 trillion in the last year. This is essentially attributed to our analytical leads, which we are leveraging full, and it has led to about 32% growth in the digital acquisition of the business.
Okay, the SBI chairman there highlighting and saying they're pretty positive and hopeful or happy rather with their Q4 numbers. SBI though of course has held out very smartly after its numbers, and I must say in today's list it's one of the few which is reacting positively to its good numbers, holding up not at the session highs. It spiked up a little bit more post its numbers. It softened a little bit from there. I don't know if we have Nitin still with us or not. We do. Nitin, SBI aside, but what about the private banking pack and the kind of underperformance we continue to see from there?
Yeah, I think if you look at the private banking pack in terms of how they trade, each of them has their own unique, peculiar issues, right? Typically a bank is best when it is doing what it is supposed to do and there's no excitement around it. If you look at out of the whole lot, there is only one of them which currently is, and the markets have rewarded that accordingly, which has delivered very good numbers. The rest of them have some issues or the other. But having said that, I think all valuations are getting built into it. If you look at the kind of price to book multiple that they trade at, they are at decadal lows. Right. It's so I just think they're from a private bank perspective, whether it's NIM compression that is expected in the private banks, whether it's the restructuring in different private banks that is happening, all of that is got built into. And I think they're trading at very attractive valuations, even if you discount for slower credit growth that would happen thanks to the tightness in the deposit market. So, in our view, that's a pack which looks interesting from a valuation perspective.
Nitin, point taken, but in the meantime, the Nifty has slipped below the mark of 22,000, that important sentiment marker that all of us were waiting for, whether it is held or not, that's given up now. And we're not seeing any incremental buying, at least as of now. The first time it went below 22,000, there was a mild green bar that emerged, telling you that there's a bit of a buying, but from there we've actually tumbled further, 21,990. And the stocks continue to be the same, which are on the downtick. L&T, a weak set of earnings. Asian Paints, ditto can be said with a 5% cut. BPCL, Coal India, ONGC, all of these are the top laggards. Shivangi, quickly comment on this. The index now has broken 22,000. What next? Is there a floor in sight?
Good afternoon. Thank you for having me. So we have seen that, Nifty has slipped from the last 4 sessions from its lifetime high zones. And clearly, India VIX has, shown the kind of panic that we've seen. And now, it's although it is testing 22,000 levels, we are expecting that, it should hold, above this zone for the next leg of rally, or else we would see like a more downside towards 21,800 levels. So 22,000 would be an important level to cross and hold and to close for today's session, for it to show some signs of strength. Although put call ratio is at lower zones, which clearly indicates that call writers are strengthening their position from the last 4 sessions.
L&T, by the way, is now down 6% on the futures. Just bring up that intraday graph, and I think L&T alone must be contributing a fair bit to the Nifty fall today. So that's quite a big fall coming in one of the large cap heavyweights like L&T. There's, of course, BPCL, Asian Paints also reacting to its numbers. It's fallen now 4%. It's at the session lows. Whereas Reliance Industries, that stock also will come off for you on your screens, down 1.5%. HDFC Bank is down 2%. So clearly large cap led weakness is what you're seeing in trade right now. Bajaj Finance also almost headed into that 3% decline coming in. Kunal, what's looking like the weakest link in the market right now?
So of course, large cap names and the private sector banking stocks, especially HDFC Bank is one of the stronger, weaker ones, strongest amongst the the weaker charts. You have Reliance Industries apparently with the stock which is holding up quite well at the 2850 odd mark till I think yesterday or day before. That stock has shown signs of weakness. And the bigger concern now across many of the large cap names is actually looking at the contribution plate. The likes of L&T, for example, that stock has now come back towards its 200-day moving average and is now contributing some 58 or 59 points on the downside for the index. ITC, a stock which typically remains a lot more sideways, extremely low beta. That stock is also down some 3-4% and has fallen below the 200-day moving average. So a lot of variety pockets from the large cap names are showing signs of fresh weakness, and I think that's adding to the concern.
Sure, okay. Jay Bala is also joining us on the technicals. Jay, clearly it's that sell in May and go away theory which is working out in the markets right now. We've quickly given up 800 to 900 points in a matter of few sessions itself from that record high level that we saw last week. What's your take on the index right now? Is there a floor inside? Do you anticipate a bounce back?
Hi, thanks for having me. Yeah, there is a floor nearby. That's 21,770. But the question is, will it hold? I've been anticipating a medium-term correction when the markets break below the 21,770, 21,710 support. The markets are trying to break that level, but today the fall seems to be a little bit overdone for the extreme short term. But the most important thing to note is that there is a cup and handle breakout on the Nifty VIX. When it closed about 16.6 a couple of days back, that's a signal that volatility is going to increase. And the markets have signaled it rightly so. And we are seeing the markets come near the critical support of 21,770 and 21,710. So I think it will hold temporarily, but from a later point of time, I think that will give way. And once that's broken, we'll look for a medium-term correction, but no preempting the markets. Watch for the critical support at 21,770 to 21,710.
Yeah, I guess, the question is, it's kind of obvious what's weighing heavy on the markets. It's your large caps, L&T, ITC, Reliance, etc., private banks led by HDFC Bank. But where is it that you find confidence to short further?
Most of the names that we have spoken about, they've risen exponentially or vertically since October of last year. So, while it may be a little bit late to short now, there is definitely enough confidence to short these names and most of the PSC names, Nifty PSC index names, and banking names. Got enough time to short it. Basically, since we are anticipating a medium-term correction, there is sufficient confidence to short most of the names because the correction is when it's likely to occur, it will not spare any of the sectors. So there is confidence, but it's not right now. We'll wait for a pullback to happen, and we'll sell the dip. Sell the pop.
Just stay with us. That was a technical check on the sudden, fall which has got accelerated in the last 15-20 minutes. But let's take a portfolio view on it once again. Nitin, we all understand that there are no major howlers coming out of the earnings season so far, which could be making people nervous. It's been a mixed bag even between performance and commentary coming out of the con calls. So clearly the needle of suspicion is all out of nervousness triggered by low turnout. Now you've seen a lot of, this correlation between or whatever relationship between national elections, state elections and markets. With your experience, what are the scenarios which are building in? A weak win by the current leadership, a strong win, or perhaps a barely scraping through? What are the range of possibilities in your view? Purely for academic purposes. Let's understand.
Well, you've thrust the role of a cephalologist on me now. So, but look, I think it's a difficult call to place. But let me just put some things in perspective. If you look at elections over the last 25 years, right, markets have generally, in the run-up to the elections, actually got it right, brilliantly. So just to give you a case in point, in the run-up to the 2004 elections, the markets were actually down 3 months leading and 1 month leading into the election. And that election threw up a surprise. Again, 2009 was a surprise and the markets were up prior to that. So the current market is clearly telling you, I think, if I go by past history, that, we are not really down big time, but it's clearly telling you a nervousness in terms of the type of majority that could come. And, it sort of seems to indicate that it's not going to be what was thought of maybe about a month ago. So it's going to be far tighter. And that's what the market seems to be telling you. And the markets, mind you, when you look at data over the last 25 years, pre-election data for 3 months and 1 month has been dead right.
Aisha, was talking to somebody who was reminding me that in 2019, again, the market was, a range of options market always believes in and starts talking about. At one point in time, a market was taking as if Mr. Gadkari could be the PM, the current PM and all. You remember? Waveless election and all. Right? Ahead of the state elections too, there was no visible wave and then suddenly numbers changed. So that is the kind of volatility. It happens in election, and that's the same kind of volatility which is being seen in the markets right now.
We're almost a month away from the verdict, right?
June.
And a month is a very long time for tables to turn, whatever numbers anyone's assuming right
But,
now.
at the same time, be it our own DIs, mutual funds and insurance, or the big HNIs I speak to across the country, this time the screen, which is mostly of intraday traders and short-term traders, may be screaming red, but people do have a lot of ammunition on the side for 5, 10, 15%. Nitin, I'm sure in your circles too. Do you think, for whatever reasons, if that severe opportunity comes in the next month or so, which are the areas which you'll be very comfortable to deploy that extra strategic cash on the side, which doesn't really tie up a whole lot with who is in power, but as long as there's a government in place, the economic momentum continues. Which are those areas?
I think if you look at it, let me just sort of continue on that previous thought and I'll come to your question. What we have seen really is elections also is more short-term noise, normally pre-election and in the immediate week, 10 days post-election. After that, generally things have settled down, and if you go 3 months out, it's like, nothing has happened. So the point is, and over a longer period of time, of course, markets have delivered. So I think if you're looking to play this volatility, I think clearly sectors which have great visibility today are sectors, for example, banking has great visibility. It's corrected on the back of FPI selling because it's an over-owned sector. And obviously, if they were to come back post this thing, that is one sector. I think the whole infrastructure names, the capital goods names, if you see corrections happening there, even PSUs, for example, if there is a nervousness, considering that the present government is perceived to be focused more on unlocking value for PSUs and giving them greater freedom. I think PSUs are also correcting. So if you see that pack, the defense pack, I think all of these sectors, I believe, are in the midst of a long-term structural story. And if you see corrections out there, clearly one should be focused to take advantage of that.
Right. Nitin, we understand that you have to go. You've got an urgent meeting or something, so we won't hold you back. Let you go on that note. Good having you on the show as always. Let me just refresh my screen and see where the rates have settled in at, because 22K definitely is back on the ticker, but you're not really seeing any meaningful recovery. I mean, giants like L&T are languishing 6%. Talk about the broader markets name. Manappuram hasn't seen any recovery, still languishing by 7.5%. Piramal Enterprises, after its numbers, got whacked 8% down. And I was just looking at the charts of Sula Vineyard as well. They too, the numbers of course have been not as at par with what the street was anticipating, but that stock is down about almost 8.5%, and this is part of many HNI portfolios. But that said, even the large caps, they are the ones which are really getting clobbered right now. Let's, we'll come to Jay Bala in just a second, but let me also welcome on board Sunil Subramaniam. Sunil, hi, afternoon. To buy the dip just yet or not is the question.
I think there will be further dips to buy at. I think what we are seeing is FII profit booking, because if you recollect last December, there was 70,000 crores of inflows into India from FIIs just after the assembly results. So I believe that while some of it could be long-term money because they were confident of policy continuity, there's also short-term money which is playing this story that the government coming back, so enter in early, and they are booking profits because today now he doesn't want to take a risk, wait for the result and have another correction and take away a bit of his profits. So this consistent over the last month and a half, we've been seeing selling by the FIS, which is essentially profit booking. And I think so that money again will come back post-elections. But because of the nervousness around the election results, because the confidence with which in December there was expectation that the government would come back has probably eased down a bit. While there's still expectation on the street is of this government coming back to power with a majority, the fact that a kind of resounding majority, which was earlier predicted, looks a little bit, market is unsure about it. So this profit booking cycle, I expect it to continue till the election results actually happen. So this May month, I would say, is going to be a volatile month. And hence, depending on what the FIs have owned a lot, like banking was one sector mentioned, right, which they've owned a lot historically, they're booking profits and taking money off the table there. So to me, good quality companies are, I think, the focus where you will, the moment there are dips in their price, it's a very good opportunity to buy them. So I would sit with my cash, waiting to see how much further this kind of volatility from FIs will go. As you saw, the AMFI data came today, mutual fund flows, SIP book again has touched a record high. You will again see that it's a kind of, consistent flow into the small and mid caps has started. So there will be broad-based buying opportunities available to fund managers and they will give us support. So I don't expect any deep correction, but volatility, yes. And there will be opportunities to buy stocks at slightly lower levels than they are today also.
Ajay, what's your view on the market mood right now? Do you think that dip today is on account of weekly options expiry? Is it just the large caps coming under pressure because of earnings, or is it that election-related volatility? And what's the best tactical trade at this point of time then?
See, I had put out a couple of notes about sell in May, and it's a nuanced note. If you visit my Twitter handle, it'll be there. And on April 24th, I had put out a thing about election strategy. And whenever the markets have broken out to record highs on an election year, there is a tendency for the markets to revisit the breakout level, either after the elections or just after the election or a little later. So, you can have a look at this on my Twitter handle. It's on April 24th. Basically, the strategy is to be very cautious, and the markets are a bit overdone, and there is a lot of euphoria. I can go on listing 10 things, and they have been classic contrarian signals for me, and it will be too long to go about it here. But the strategy is to watch for critical support at 21,770. If that were to break, I think it's a matter of time. If it does that, there'll be a surprise drop for a lot of people, because most of the players are very bullish on the markets, and markets tends to reward people who are on the minority side. That's how the money flows. Money flows from the majority to the minority. So right now the position is overly bullish, but we are not preempting the markets. We are watching for critical support to break. We are not overly bullish on the markets. We are very specifically bullish on certain names, but the strategy is to be ready to sell the break of critical support.
Let's flip the position. I mean, it has been trending lower. Very clear short trade has been playing out for almost over a week now. So let's look at it from the people, the traders side who've been short on the market last 7-8 days. Shivangi, if you were a short guy and you've been deep in the money right now, what levels would you like to reduce or take some profit off the table and again short back? Or if not a trending guy but a positional trader at what levels will you start initiating buy calls? Because this is clearly a confluence of big FI selling and nervousness on the election front, clearly. So do you expect any short covering to start, say, in the last week of May series or the first week of June series, when election results are also there? Where would you reverse your short trade?
Absolutely, Ajay. This has been discounted in the market as well. And 21,950 was a crucial level, which we are seeing, close to that. But 21,777 would be an important level, which was the recent low as well. And that would be a trigger point for, people to start booking their shorts or add longs at that point. So this is what is expected. And as rightly said, the election result is just a minor event. It's the weeks before and after that which makes sense. And this is just from the last 4 sessions that we've seen. It might be the intensity of the fall will decrease as we head towards the result dates.
Great to have you on the show. We'll let you go on that note as well. Thanks always for joining in. And Jay, thanks for making time out and joining in today. Still not out of the woods. We're down 285 points in the Nifty futures. The Nifty now, in fact, we've fallen not just below 22K, but I think 21,950 also is going to get tested pretty soon because the selling doesn't seem to be abating. We'll take a quick break, continue tracking markets on the other side.
All right, Aditya Agarwala is also joining us to talk technicals, but we have Sundaram Mutual Funds also right now. Sunil Subramaniam is there. Sunil, I was looking at the data. The DIF flows was showing some kind of a risk off, at least the small cap, mid cap end of the flows last few months. That seemed to have got halted. What are your thoughts there? People have started coming back to small cap, mid cap?
Yes, because I think SEBI's statement around froth in certain segments of the small and mid caps had led to a little bit of, I wouldn't call it panic, but nervousness in investors saying, is this SEBI statement and the mutual funds were required to disclose their liquidity and concentration and all that, is that going to lead to some correction? So there was a little bit of a pause. So if you see, along with that, the SIP book had also paused at 19,100, 200 levels. But the moment the mutual funds release the data to show that there is no liquidity concern and that they're all well diversified, I think the small caps have started to rise again and the flows are also following that pattern. So I think it was just around the SEBI remark that there was a hint of nervousness in investors, and that month you saw large cap flows also go up a bit. Now it's again, order has been restored, large cap funds have come down, but I'm happy to also note that people are not only added to small and mid cap, but flexi cap, multi cap, those diversified funds have also seen incremental flows. So there's a maturity of the investor coming in here, and they are broad basing it. And the essential reason for this is the confidence in the economy, domestic economy, because that's where it's closely related to mid caps, and Indian investors are also aware of the economy and its growth. So I think, to summarize, yes, there was a little bit of a blip in terms of worry over small and mid cap valuations. They continue to be at a premium to large caps, no doubt, but that's on the basis of an expectation that as the business cycle progresses and capacity creation really picks up steam, it's the domestic economy and the small and mid caps which will post higher and higher EPS growth, better than consensus estimate, and hence these whatever you call that, very high valuations related to large cap would get justified by the superior earnings growth. That's the expectation. So if you factor in those earnings growth actually happening, then they are not overvalued. The only issue will be if there's a negative surprise on the earnings growth, which as the coming quarters will reveal. But otherwise, I think the nervousness around investing in small and mid cap has, I think, eased. And that's why 1,000 crore rise in the SIP book, of which my estimate is 60 to 70% would have been in small and mid caps, right? Indicates that resurgence of the confidence in that space.
Whenever there are signs of some bottoming out, while you do anticipate further weakness in the markets, tactically should one look at higher allocation towards small and mid caps, which have done well, and that's more, I guess, a specific stock by stock story? Or do you think it's the large caps which are going to come back faster because they are the ones which have been beaten down also more?
So I would say that's a time frame thing. For a year and a half, large caps would be the better place to play because a lot of the growth of the next 2-3 years has been factored into mid and small cap prices. So if you have a 3 to 5 year outlook, then picking good quality mid and small caps makes sense. But over the next year and a half, because the FIs have gone out and hence large caps have corrected, when they come back, immediately large caps will bounce back. So with a short term 1.5 year view, yes, it makes sense to have a high degree of large caps in your portfolio. But if you have a slightly longer stretch and look at the domestic economy as a key driver of EPS, then small and mid caps should outfully continue to outperform. So it's a time-driven thing. Second is your ability to manage volatility. Right, large caps not only in the short term will give you good returns, they'll also be less volatile than small and mid caps. So for an investor temperament, right, if you are comfortable with taking risk and managing volatility, then small and mid caps will continue to be your growth drivers. But if you are a little moderate there and you don't want too much of a volatility in your portfolio, then adding a little more. So I think the right answer is to look at the flexi cap, large and mid cap, multi cap as a space to put money in, because there you automatically get this allocation across the cap curve.
Aditya, you look at options as well. At this hour, 3:10, certain section of the market is screaming red. But what is the option data telling you right now? PCR, RSIs, all of that put together. Any sign of near-term rebound or not quite?
Yet, Ajay, to be honest, if we take a look at the way option data is panning out at the start of the day, trading session 22,200 had the maximum open interest, and then it shifted to 22,000, and now if I look at it, maybe 20,000 to about 22,000 below, we are seeing expiry. So clearly the option data is suggesting markets will expire below 22,000. There is a huge buildup in the call side. At the morning, the PCR did jump a bit, which showed that there is a bit of a long buildup, but that has again shifted, Ajay. So there is no sign of any long trade yet. But yes, markets are looking little stretched and oversold. Yet to call a bottom. Tomorrow will be a key trading session we need to watch out for. Usually these sharp down moves see a positive divergences building up on shorter term time frame charts with respect to RSI. So traders should watch out for that in trade today. If that starts to happen, then maybe we could be in for a good short covering rally. Apart from that, there is a clear sign of sharp weakness in the market.
Okay, with that sharp weakness, we'll take a very quick break and come right back. We'll track the last few minutes of trade this afternoon. SBI, that's had quite a choppy ride actually after its numbers. Quite a bit of crisscross, and now finally it settles in with that 0.5% gain mark, clearly off its day's peak. Hero MotoCorp still going strong. TVS Motors still holding out. Tata Motors ahead of its numbers tomorrow is still looking very, very strong indeed. And so is M&M, by the way. And a couple of these technology names are the ones which are actually still holding on to their gains. But let me take it across to Ansh, find out what are some of the volume buzzers in trade. Ansh?
Right, so let's start with one of the top draggers of market actually, and that's HDFC Bank. The stock is contributing over 50 points in Nifty's down move and over 250 points in Nifty Bank's down move. The stock has actually given a breakdown from its critical support of around 1,480 level, and it has also slipped below its 50 DMA, touching 1 month low, indicating very strong bearish sentiment in the stock. Apart from this, Hero MotoCorp will also be in focus as the stock has actually given a breakout from its downward sloping resistance trend line with over 5 times its volume as compared to its 10 session average trading volume. The stock has also touched 2-month high level on intraday basis as well. Lastly, Tata Investment will be in focus as this stock has actually also given a breakout from its downward sloping resistance trend line, and it has also touched upper circuit of 5%, surpassing about 20 DMA level. So keep an eye on the stocks.
We shall watch out for that, and we're watching out for what's happening at the index level itself, because at one point of time 21,950 was a bit of a support. That's also getting completely broken down right now. 21,938. A quick word coming in on Jefferies and SBI, and that would explain the kind of tumble we have seen in the last few minutes. They are acknowledging that the numbers have been ahead of estimates and the NII growth is higher than estimates, but the majority of the beat is led by lower staff costs, higher treasury gain and lower provisions, and some of these may not be recurring in nature. So the quality of earnings is what they are questioning. Yes, the slippages remain low and the gross net NPLs are down marginally, but I think it's more about the quality of that sustainability of the beat in profits is something to watch out for. We also have Sunil Subramaniam still with us. Sunil, just wanted to get a sense with respect to the private banking names. At what level or at what point of time would you be a buyer in the likes of Kotak Mahindra Bank, HDFC Bank, ICICI of the world?
I think I'll be a consistent buyer because these are, one, over ownership by FIIs. The second, the overall, it started with the RBI clamping down on retail lending, increasing margins there and capital adequacy requirements. But if you look at the fact that as a growth story of the Indian economy and as discretionary consumption picks up, right, you will see these banks again being the leaders in lending. And I would always back these strong because they are well capitalized, well professionalized, good systems and processes. So I think short-term corrections remain a good opportunity to accumulate these because as they are well owned. So I already own most of these in my portfolio, let us say. So adding them on the dips makes sense because I'm not getting rid of my portfolio, right, as a fund house. So I think that to the extent that we like some of these banks, where we already hold them, we'll continue to buy them on dips. I don't see any major concern around this. And I think NPL levels will keep coming down gradually. Net interest margins will be under pressure, but the volume of loan growth, as private corporate capex over the next 6 to 8 months also comes in, will definitely compensate for the drop in margins. So if you look at NIM into loans, right, the value absolute EPS growth should come in well. So I continue to be a buyer, and these every dip that's there in good quality private sector banks.
Buyer in the good quality private banks. Thanks so much, Sunil, for joining us and talking to us about your market view. But in the meantime, let me take it across to Kunal as well as Aditya to talk to us about their top trades right now. Aditya, what will be the best tactical trade, a BTST, STBT idea?
I've got both, Anisha, an STBT and a BTST, because clearly the markets are weak and there are pockets which are outperforming. So first STBT is on the Cipla. Clearly stock looks weak. I think there is more downside in the stock. One can go ahead and short the stock at current levels. Look for a target of 1280 on the downside with the stop loss at 1400 on the upside. Second is a buy on the IT front. Clearly IT stocks are bucking the trend and looks like you could see further upside in the IT stocks. So Infosys looks strong. Can be done a BTST here for a target of 1520 on the upside with a stop loss at 1400 on the downside.
Kunal, what's on your list? STBT or BTST?
Yeah, combo of both BTST and STBT calls. So first one is about HUL. So apparently that stock is still holding on to the breakout which they had shown 2 days, 3 days back for itself. So would suggest a buy with a target of 2470. Stop loss could be kept at 2250 mark. And Granules is the stock which is now nearing a break towards its 200-day moving average. So would suggest a sell with a target of 380. Stop loss at 402.
Okay, so it's a mix of STBT and BTST coming in from our traders and the chartists. But, markets and mandate, that's the big talking point right now. And we have been posing this question to a whole host of market experts as well. Listen into a slice of conversation we had with Hiren Ved earlier to talk to us about how one should approach this market, because it's clearly very volatile. Right now as well, we are below the mark of 21,950, and it's the heavyweights which continue to drag their feet. So L&T, Reliance, HDFC Bank, ITC, Asian Paints, all of these stocks are down and out. SBI is continuing to have a bit of a wobbly ride. But Kunal, what's your take on the auto pack? There's a bit of a strength there. Hero MotoCorp is still 3% higher. Is this the safer bet right now as a buying opportunity?
Yeah, in fact, over the last couple of days, I've been highlighting that auto is the only sector which is showing signs of relative strength as well as resilience. And I think today also, when you look at the large cap auto names, I think Maruti, Tata Motors, to a larger extent, M&M as well as Hero MotoCorp are the ones which were trading with a slight positive bias or at least a flattish bias in this kind of a market environment, which again is a strong indication of the strength and the relative strength into these pockets. But when the market gets into a corrective phase, into a risk-off mode, sooner or later, even these stronger sectors relatively, they also get into a profit booking mode. So would not advise any building up of fresh positions over here. But I think traders who have been holding on to long positions, for example, for the likes of M&M, Tata Motors, etc., I think it could be a good time to try and at least book out 50% profits and trail stop losses for the balance.
What about FMCG, ex-ITC, of course, which you've already talked about, Kunal, because that uptake was rather short-lived.
No, but at least there was a strong case of a volume built up for the FMCG names, which was not the case earlier. And when the market gets into a volatile phase or into a high beta zone, it's FMCG erstwhile defensives which form a sector where traders they generally or investors they generally park their money because of the sudden bout of volatility. So at least what we've seen for many of the FMCG names that they have not gone back to their 3-day, 4-day swing lows for themselves. So yes, these stocks are rallied up by a margin of 10%, 15%, some of them 5% odd, and they've retraced also just 1 or 2% or maybe 50% of the gains which these stocks have done. So I think that's also a good enough indication that buyers are still intact. The volatility into this sector is dropping down, and if these stocks they don't fall below their previous swing lows, there could be a strong case which could be built that FMCG stocks can stand to outperform going forward.
Okay, FMCG stocks might outperform, but what's been outperforming of late is India VIX, that kind of 70-80% surge that we have seen in a matter of 10 trading sessions. For 9 days on the trot, that index was higher, and today as well, clearly it's the 10th or the 11th day that index has been higher, almost sitting that 18.5 mark now. Of course, intraday we did see that wild move to the 19 level. It did cool off from there, but still high by 7% right now. And if you pull up a 1-week chart, or maybe a 10-session chart if we can, or even 1 month, that will tell you the massive surge that we have seen, because at one point of time it was at a 5-month low, sub 10 mark. At that point of time, we're all wondering what's happening. The election is around the corner, earnings are around the corner, but India VIX wasn't moving, and now there has been that sudden spike in the last 10 days. But we were talking about how, of course, we've been speaking about the entire mandate and markets with our top guests. Let's listen in to what Hiren Ved had to say on the same.
Yes, today it is fair to say that the market believes that there will be continuity. So, if something goes wrong with that hypothesis, will you get a deep correction? I think you will, right? But we've seen historically that if the underlying stocks that you own have fundamentals, they have earnings behind it, they have cash flows behind it, value will come back. Same thing happened in COVID, right? I mean, nobody knew what COVID was. Nobody expected something like a lockdown could happen where everything would be shut down, and markets fell aggressively, but they came back. So I think, after an initial jerky period, rationality will prevail.
I think one space we are circumspect on is the newer listings, which are more startup kind of names. Where they were privately owned and they came for listings, and some of them are breaking even, some of them are in small losses, and the whole focus is on revenue growth and going into newer areas. Now, let us say there are 10 such listed businesses, maybe 2 or 3 of them will do well, but most of the businesses could end up losing money for investors. I don't know which ones will succeed, which ones will fail, but today you see digital advertising for this 10-minute grocery delivery. There are at least 5-6 players competing for that, and it's not something which is a very, very high margin business given the relatively low ticket size and the need to have so many people feet on street and things like that. So I'm circumspect on the startup kind of businesses. The other space which is mind-boggling to me is the consumer names. Now, a lot of people keep saying India is the growth area and our GDP growth will be so strong and things like that. But some of the FMCG names and some of the retail names, one is seeing that there are growth challenges. In fact, in some of the FMCG names, growth is very, very similar to developed countries. And we have valuation multiples of 60, 70 and 80 times earnings, which really baffles me.
I think there's a notion that all large companies have great efficiency, all large companies have great corporate governance and so on and so forth. And it's also not a right notion to put all the mid and small caps in the same basket saying that they have bad capital efficiency and they are not good management. I don't agree with that. In fact, some of the smaller companies are managed by entrepreneurs who are like way beyond what you can see. And in fact, some of the large companies, particularly the multinational companies, have time and again shown, that their corporate governance has a long way to go. We have seen companies in the private domain as well as on the listed space. We have seen now issues where, what they are giving to Indian consumers and what they are giving to the developed nation consumers as a difference. You can't treat India as a second-grade thing. You have massive royalty which is being given. So I think this is a notion that large companies are good, great, and smaller companies are not great. Having said that, I completely agree that there is a section of the mid and small cap where there is over exuberance, where there is to some extent significant overvaluation. And I think that will always happen. Markets are never fairly valued. They will either be overvalued or undervalued from time to time. And it is upon the investor to, as I said, have a discipline and not get carried away just because the price is moving.
Right, okay. A lot of market perspective coming in there, and definitely today has been quite the terrifying Thursday to say the least. But we thank all of our experts for joining in, and let me hand it across to Vinny to find out how the closing trades have been.
So looking at the closing trades, not a very exciting day. Terrifying Thursdays is what you said, and that is what it looks like, because Nifty closing below the 22,000 levels and 21,945, down almost 1.5%, 1.6% in trade. So clearly we have seen the fall in the Nifty, which is intensified by the end of the day, and there was no sort of a recovery that we saw coming in for the benchmark indices. And even today, the broader markets didn't see a bit of a positive participation. Nifty mid-cap down 1.9 to 2% in trade, almost 2% in trade. Nifty small cap 2 is down similarly. So clear underperformance coming in on that front. Advance decline ratio, there's no guessing there. It's in the favor of decline versus advances. Now, what dragged the market today in the Nifty 50? When you look at it, we did have L&T that saw a sharp fall coming in. Other than that, we had BPCL, which was also falling sharply in trade. We did have HDFC Bank, Asian Paints, which reported its numbers. But yes, nothing exciting happened for Asian Paints, down almost 4.5%. In trade, Coal India, ONGC, Divi's Labs among the top losers. Now, what managed to hold on to some bit of a green in the Nifty 50 was the auto pack. So when you look at the auto names, TVS Motors, Hero MotoCorp, Tata Motors, M&M in the Nifty 50, while TVS Motors also managing to hold on to good gains today. And, let's not forget Hero Motor as well as TVS Motors actually reported their numbers yesterday. We're keeping an eye out on that. SBI also strong gains that came in for SBI after it's reported its numbers, swinged into the positive side and holding on to gains of 1.13% even at the end of the day. Other than that, let's look at some of the other names that are moving in trade today. We did have Muthoot and Manappuram Finance that were holding on to some bit of a negative decline because, yes, there was some bit of a news that came in from RBI in terms of NBFC's last day meet. So keeping a bit of these stocks under pressure. Bajaj Consumers, other than that, Sula, Piramal Enterprises and DLF, all these were the other stocks that were buzzing in trade today.